Well, good morning and welcome to the bank. With me, we've got John McDermott, who's the Chief Economist and the Assistant Governor for the bank, and Willie Chetwin, who's the Manager of the Forecasting Team. The Reserve Bank today left the official cash rate unchanged at 3.5%. The global economy continues to grow at a moderate rate, and inflation remains below target in most advanced economies due to spare capacity and declining commodity prices. Our economy is growing at an annual rate of around 3.5%, and we are projecting growth of a little over 3% over the next 2 years. While dairy prices have declined sharply, household incomes and consumption have grown steadily, and construction activity remains strong. Interest rates remain low by historic standards and continue to support domestic demand. Consumer price inflation was 1% in the year to September. Much of the moderation reflects weak global inflation, the fall in international oil prices, and the high exchange rate. The modest inflation pressure suggests that New Zealand's expansion can be sustained for a considerable period with a more gradual increase in interest rates. Underpinning the expansion is the increase in the economy's potential capacity, which is being boosted by high labour force participation, strong net migration, and continued investment growth. Our expectation is that inflation will reach the 2% midpoint of the target range later than earlier forecast, but that some increase in the official cash rate is likely to be required at a later stage.
I think you have to remember there's a good news element story here. Inflation has turned out to be lower despite the absorption of capacity, and that gives us a lot more options with monetary policy going forward, and is part of the story here where we see the growth profile actually lasting longer. So we now have a story where the economy is above trend for longer than we had back in September, and probably a profile where the unemployment rate also comes down more than would otherwise be the case.
What you're seeing at the moment is maybe the start, time will tell, of a strength in the US dollar. And if you look at real exchange rate swings in the US dollar, they tend to be quite long. And you can go back over the last 3 big cycles, and it's not unusual to see an upswing in the US dollar of something like 4 to 5 years. Now, I think most traders came into this year expecting the US dollar to appreciate, given what happened in May last year around tapering. And given that tapering did actually start in December, they came this year expecting the US dollar to appreciate. It looks as if we're now starting that phase. And in fact, if you take our cross rate with the US since July, we're down, I think, around 13% at this point.